All right, hello everyone, and good morning. It's my pleasure to welcome everyone to another Trust Vista Talk webinar. As always, I'll do a quick introduction and then hand it over. So Trust Vista, for folks that don't know, is the leading outsourcing firm for the financial services industry, and we support clients by providing skilled outsource support across due diligence, business development, portfolio management, data analytics, and other activities. As always, to learn more about us, feel free to visit our website and follow us on social media. We also have a podcast where we do one-on-one conversations with senior asset managers and advisors. And we have a really interesting topic today. And without further ado, I'll hand it over to Avi and our panelists for the discussion. So take it away, Avi.
Thank you, Amir, and welcome everyone, and thank you for joining us today. I'm Abilash Jaikumar, the co-founder and managing director of Trust Vista. Today, I have the privilege of discussing private equity investments in 401ks with some of the industry's thought leaders on this topic. And I'll have them speak in more detail about their experience with this matter, but a quick introduction of our distinguished panelists. First, we have Douglas Keller. Doug is the head of private wealth and defined contribution at Pantheon Ventures. Pantheon is approximately 50 billion in AUM. And Doug focuses on the origination and marketing of registered and unregistered offerings to wealth management clients globally. Before Pantheon, Doug worked in the Merrill Lynch Alternative Investments Group, where he was involved in screening, structuring, and offering private equity and private real estate investments. Next, we have Jason Mulvihill, a fellow Georgetown Hoya, who serves as the Chief Operating Officer and General Counsel for the American Investment Council. He is responsible for the legislative, regulatory, and international matters considered by the AIC and oversees AIC's Regulatory Committee, Tax Committee, and General Counsel's Committee, as well as the Chief Compliance Officers Working Group. Before joining the AIC, Jason served as a Legislative Director and Chief Counsel in the United States Senate. Last but not least, we have Lawrence Cagney. Larry is the chair of Debevoise and Plimpton's Executive Compensation Employee Benefits Group and is recognized as a leading lawyer by the Legal 500 US. Larry designs compensation plans and programs for public and private companies and assists them with related SEC reporting requirements and tax issues. He also advises financial service clients and investment funds on the fiduciary responsibility provisions of ERISA with respect to the investment of pension plan assets, including VCOC, REOC, and other plan asset issues. Thank you all. Maybe now I would love for each of you to maybe give a quick background on your experience. Doug, if you'd like to kick us off.
Sure. Well, thanks for having me, Abby, and certainly thanks everybody for joining. My name is Doug Keller. I do manage the wealth and the defined contribution business at Pantheon. We've been highly interested in the defined contribution space for the better part of a decade now. We initiated our dedicated effort in late 2012, and we have created a specific product that we market to defined contribution plans in the US. As a part of that effort, we heard from the plan sponsor community time and time again in terms of the overarching sort of risk of litigation within the DC space, and we endeavored alongside a frenemy, so to speak, in Partners Group to engage with the DOL and try to catalyze some guidance given to this issue, which ultimately culminated in the release that I'm sure most of you have seen in the last 6 weeks. So very excited to talk about that today, and excited to be here.
Jason?
Yes, Avi, thank you. Yeah, look, I come at this from the trade association perspective, and we spent a lot of times over the last decade talking about private equity, defending its model, and really trying to show folks that this is and has been for some time the best performing asset class for pension plans. And we at the AIC are certainly very excited and in support of the expansion that DOL has allowed here with its practical guidance. We look forward, if pension plans and pensioners can get access to the best performing asset class, why can't there be a way for more retail investors to get access as well? And so we think that the DOL's role here was a positive one, and we look forward to the discussion ahead today and to how the investing public hopefully will get greater access to private equity going forward.
Great, thank you. Larry?
Yeah, so Debevoise is one of the preeminent private equity law firms in the country. We have quite a number of clients who are private equity funds, and as an ERISA lawyer, I have spent many years facilitating investments by defined benefit plans into private equity investments, and have for the last several years been working with some of our clients on trying to find a path to bring private equity into 401k plans, and worked behind the scenes with one of our clients who, at the same time as Pantheon, was trying to influence or persuade the Department of Labor to provide the guidance that they provided in order to facilitate access for 401k plan participants into the private equity market, and worked on a piece of guidance that we suggested to the DOL, from which they borrowed somewhat in giving the letter that they provided to Pantheon.
Wonderful. So maybe to start the conversation off, since I'm sure most of the folks in the audience know that in June the DOL issued that guidance, paving the way for conversations about DC plans participating in 401k. And looking back further, with the Pension Protection Act of 2006 mandating that retirement plans offer diversified investment options, it was only a matter of time before private equity proponents followed, target date funds and annuity contracts down the path to general acceptance. Taking a step back, Larry, how would you summarize the journey thus far, and how did it come about, and why has it taken as long as it did?
Sure. So, one of the issues is how to get private equity into a plan. And when 401k plans are all designed to be what are called 404C plans, or mostly designed to be that, where participants get to choose their investments from an array of investment choices made available by the fiduciaries of the plan. Those choices tend to be have daily liquidity these days. And so, the introduction of a private equity fund had to deal with issues like being benefit responsive, the ability to take withdrawals, the ability to transfer from one fund to another. And so that presented a complication. For example, if you were to have a fund that was available that was entirely in private equity investments, because the question would be, how do you get the liquidity to do those things? Also, the bigger problem, though, is sponsors of defined contribution plans have seen plaintiffs' lawyers discover ERISA as a tool to bring litigation. They brought a lot of litigation over fee issues, and obviously private equity has a different fee structure than an index fund, for example, or even an actively managed mutual fund. And so the fee issue was one that concerned sponsors. And then also, just from the point of view of being different, because the vast majority of these plans, because of the ease of administration, are invested in mutual funds that have daily trading. And so there was a reticence on the part of sponsors, despite the goal of achieving a better return for their participants, to put themselves in a position where they could be challenged on whether or not the investment they were making available was prudent, whether or not it was in the best interest of participants, because the fee structure was slightly different than they were used to. And so one of the objectives in the path to getting guidance from the DOL was to try to get the department to confirm what is very clear under the statute, is there's no reason that private equity can't be one of the choices under a 401k plan. But the key here was to do it in such a way that the sponsors would take comfort that they were complying with their fiduciary responsibilities in so doing, and also at the same time give them some level of protection that they would not be subjected to litigation where just the presence of that investment would get past the pleadings, get to a point where they were embroiled in a full-blown discovery and expensive litigation. And so that, I think, is the biggest benefit of the guidance that we've received from the department. But it took time to think through the mechanisms, the manner in which to develop these products, to design, to suggest, as we've seen, there's a tremendous growth in target date funds, and a target date fund is a great way in which to mix private equity in, because by having a component of private equity in the target date fund managed by a sophisticated manager who has the experience to choose those investments wisely and prudently, it also gives the opportunity for the fund that holds the private equity to meet all of the benefit responsive needs. But primarily the risk here, the reason it's taken so long is because the market has been, geared in the 401k space to daily investments, daily funds, immediate liquidity, and not focused on the benefits of long-term investment and long-term returns. And I think you've seen that changing with sponsors, and with this guidance, hopefully the fear of litigation will recede to the point that they can introduce these investments.
So certainly if that DO letter reduces that fear of litigation, there's still remains a lot of practical challenges to implementing private equity as a meaningful component of 401k plans. Now, what are the hurdles that remain before this can be viably implemented? And maybe how does the current global situation factor into the near-term outlook? And I'll pose that question maybe to Doug. And certainly, I think all of you would have a view on this. Doug, I think you're on mute. Or you're breaking up.
It's a very good point, and Larry did allude to some of the more technical hurdles, and it's very relevant in terms of what we've seen in our experience. When we first endeavored to create a defined contribution effort in business, we focused our efforts on the more technical hurdles from a product development standpoint. How do you fit private equity, which is sort of a square peg, into the round hole that is the 401k plans? How do you manage daily liquidity? How do you put forth a daily price? How do you let participants come in and out of these products when inherently the underlying investments that you're making are illiquid and only valued on a certain relatively infrequent basis? And so the good news is there are ample precedents across the asset management industry in terms of solving these issues. I think private real estate is a very good example to look at over a long period of time. And what I mean by that is there are sort of generally accepted ways to deal with sort of how to value and how to provide liquidity in an inherently illiquid asset class. It's not an easy thing to do. It takes a massive amount of thinking and effort and sort of product structuring and product development. But we do think that the industry is headed in that direction as a broader sort of effort to get private equity into the hands of more investors, period, outside of institutions. With regards to the current global situation and the COVID pandemic, I'd say it's a case of a double-edged sword, so to speak. On the one hand, I think plan sponsors are very focused right now on the things that are sort of 6 inches in front of their face. They were very focused on the legislation that came through the CARES Act and providing, the benefits of an overarching retirement plan, making sure that people that needed access to liquidity could get there. And I don't think, over the first 6 months of this year, there was really a lot of tolerance by plan sponsors to do anything sort of new and different. On the other hand, it's easier to contact people in this environment. It's easier to have, live conversations, as counterintuitive as that might be. It's actually quite a bit easier to get in touch with people in this virtual environment. And so I think we've been fairly pleased in the sort of 7 or 8 weeks since the DOL guidance has come out, that the level of attention that this issue has been getting is not just in the media and it's not just in the GP landscape, but actually there's been an incredible amount of activity and outreach from the plan sponsor community, which we think is really important.
We had a webinar last week about the fundraising environment, and more specifically, we talked a lot about the LP-GP relationship, and a lot of that was in this type of environment talking about communication and transparency. Now, Jason, it's often been argued that PE investments are complex and opaque to an average investor. What steps has the industry taken, and maybe should take, to further educate plan sponsors and retirement savers?
Yeah, I mean, it's a really good question. And again, I come at this from the perspective of, look, we're actually a highly transparent industry for our investors, have been for quite some time. That transparency has really only been heightened over the last decade plus with post-Dodd-Frank registration of most private equity fund advisors, and with a tremendous amount of disclosure that goes not only to our our LPs, but also to our regulators. So oftentimes the people you hear most, the sort of the canard of, you're opaque line from is usually the media, right? And often people and some policymakers who say, I can't invest in private equity myself, and I don't know a lot about it because I don't see a lot of advertisements about it, and what I know about it I hear on from a newspaper article, and I have questions. So I do think going forward, as you look at the greater investment opportunity in the retail space, starting with target dated funds and hopefully going kind of beyond that, I do think the industry will need to make an effort to continue the education process that's already very present with all of the investors that we already have in our midst, and to make it I think as easily digestible as we can for not only for potential investors and ERISA fiduciaries, but also for policymakers as well, because I think in many ways private equity historically has been sort of one of the best investment stories never told, and I think that it's incumbent on the industry and those who advocate on its behalf, including the American Investment Council, to make sure that people are aware of the value of private equity, why it's a great thing for the economy, why it has a long history of being the best performing asset class for its investors, including pension plans, university endowments, charitable foundations, and why it makes sense for people to consider investing at least a portion of their retirement, from a 401k plan in private equity to get not only higher returns, but a number of recent studies have emphasized the fact that it's higher returns coupled actually with less risk. So, another canard you often hear is, the reason why more retail investment doesn't happen in private equity is because it's inherently higher risk. And the reality of it is that there's some folks who've taken a look at this, Greg Brown at UNC, a number of others, Georgetown's done a few good studies on this, that look not only at the fact that private equity returns are always exceeding public benchmarks, but also in some cases that it actually can reduce risk for investors. And so I think highlighting some of those points and making private equity for the retail investor a less mysterious concept, I think will be very important. And I know people are already working very hard to do that, and that work will continue going forward.
Yeah, I know on the transparency part, we're working with a lot of our clients on the GP side to do portfolio reporting in real time to their LPs. So there's dashboard and software tools where LPs can look directly through at any time and see what the monthly financials, and more than financials, just operating metric KPIs as well as the portfolio companies.
Right.
Obviously, there's a lot of confidential information that's being shared. So with the retail audience, some filter may have to be considered, but still ensuring that level of transparency to
right. And I do think, I guess the one, I think that's right. I think the one other thing that's helpful here, as well as I think Larry and Doug had mentioned earlier, is look, you're dealing in this case with target date funds where you have an ERISA fiduciary sitting in between the DC plan investor and the private equity fund that may be offered as an option for investment. So I think again that that's a very helpful thing, and I think again just it enables more retail investors to get access to the best performing asset class, all within the protections of their ordinary 401k investing, and that's a plus.
The growth we've seen in target date funds within the 401k space is indicative of the fact that the average participant doesn't feel confident being in charge of his or her own investments and wants to look to someone else who has experience to put together a portfolio of investments that's going to give that participant an appropriate level of returns over their working career and building toward their retirement. Because, when I first started in this field back in the 1980s, savings plans, 401k plans, were supplemental to retirement because large companies had defined benefit plans and the participants could rely on those benefits for their retirement. But now 401k plans are the primary retirement program for the vast majority of participants. They need to get good returns on that. They need to have opportunities that are going to reflect their own investment horizons, because there's no reason a 30-year-old, a 35-year-old, a 40-year-old needs daily liquidity on 100% of their retirement assets. And so giving the opportunity for them to make these investments, but they don't even feel confident choosing between, the typical S&P 500 index, an emerging markets fund, a balanced fund. And that's why the target date funds have become so popular. And as Jason said, the people who will be making the decisions as to the particular private equity are sophisticated investors, are familiar with this product because plan sponsors are familiar with it because it's been in DB plans and been one of the better returning asset classes of DB plans for a very long time.
Yeah, and obviously with the reduction in the number of private pensions that exist, more of that capital is flowed to 401ks. And today, there's nearly $6 trillion in retirement assets in 401ks. Jason, from an asset allocation perspective, how do you see the long-term potential for 401ks in private equity, and maybe even just in the short term? Should we think anything's going to change in the short term?
Well, I guess it all depends on how you define short term, right? I think over the long term, you're going to see this will be of tremendous benefit to 401k plan investors, and obviously it's not that 401k plan investors and target date funds are going to invest 100% of their assets in private equity, but investing a portion of their assets along with a diversified asset portfolio makes an awful lot of sense. And again, we tend to think that just as in the defined benefit space, there's a long series of 30 years of data plus that show how private equity helps defined benefit plans outperform and really do better than DC plans. We think that as more ERISA fiduciaries and as more defined contribution plan investors get a comfort level with the asset class and are exposed to more opportunities, this is going to be a net plus, a very big net plus for retail investors, for ordinary investors, and that's a great thing.
Yeah, and Doug, how are private equity managers setting up to tap into 401k plan? Can you maybe give us a rundown of the approaches the industry might take and the barriers that need to be overcome concerning their distinct risk appetite, liquidity and return expectations?
Yeah, so I think that, it is a number of things that I alluded to before in terms of how do you fit a regular private equity fund, which is typically a private fund in a 10-year term with capital calls and distributions and quarterly valuations. How do you fit that into a world that is very focused on daily valuation, daily liquidity, or at least the prospect of both of those things? I think, taking a step back, it was important for us when we first started this initiative to think about fitting private equity within a target date fund complex. That's been our strategy from day one, even before we engaged with the DOL. Frankly, that's from an asset allocation perspective, it's from a regulatory perspective, but also just from a commercial perspective. It's easier to fit private equity into that construct than as a standalone option within a plan where you have to give somebody the ability to sell that fund on a daily basis. And so, taking a 5, a 10, or maybe even a 15% allocation of a sleeve in a target date fund makes a lot of sense from a lot of different perspectives. From a valuation perspective, you start to be able to, see very clearly what the precedents are. You do have large mutual funds and large CITs that are already investing in private companies as a small percentage of their overall portfolio, and they're not marking those companies on a daily basis. So there are registered mutual funds out there that invest in private companies that are either shifting those valuations on a monthly or a quarterly basis, and it's generally accepted today. Similarly, in private real estate, there's sort of a tried and true method in terms of how to value a building on a less frequent basis than on a than daily, and sort of a widely accepted way to go about that within a broader asset allocation fund complex. We think that that's incredibly important. We also think from a liquidity standpoint, as you can imagine, it's much easier to deal with capital calls and distributions within the context of an overall target date fund complex than within a single fund structure. When you're talking about working with a sophisticated plan sponsor that has a lot of experience in investing in the private markets, maybe on the defined benefit side of their house, they have a lot of experience in terms of managing liquidity, and they can marry that experience with the experience that we have as a multi-manager investment platform. And together we can figure out a way to efficiently invest a small subset of that portfolio within, again, the broader construct of a target date fund complex. And so we do think that the industry will continue to evolve, and the way that we strike a daily NAV or the way that we might offer liquidity within our offering is not the only way to do it. It's not the only way that others will do it, but we do think that the industry will sort of triangulate on sort of one, two, or several baskets of the way to solve these issues, which really come down to liquidity and valuation. We think that, further, the multi-manager approach is going to be sort of the first leg into this. It will be very difficult, I think, for a single manager or a single fund GP to create an offering that meshes with the specificity of the DOL's guidance. And we didn't talk about this before, but Larry alluded to the sort of the main advantage of the guidance, which is very clearly that private equity can be incorporated into a plan under ERISA law. But from our point of view, sort of equally as important is the detail in which the guidance went into in terms of providing a fairly clear framework about the types of things that plan sponsors need to be thinking about and evaluating when actually thinking about adding private equity to their plan, and we do think that it leads the industry towards a more multi-manager approach.
And Abi, one other development, because you asked about the length of time, but one other development in the private equity marketplace that coincides with the introduction here is the activity in the secondary market, because someone who's going to start today on a target date fund, if all they had access to was primary investments, it would take time to develop the amount of assets that were actually committed into investments. Whereas with an active secondary market, they can go out and make immediate investments into existing investments and get different periods of investments for their assets instead of starting out now and waiting for the growth of that to happen. So there's more flexibility for the manager who's going to be developing these assets today than there might have been, for example, 5 or 10 years ago.
Now that's an interesting point. We had a conversation with a bunch of secondaries managers a few weeks back, and one of the things we're talking about is the amount of dry powder, not just in private equity generally, but in secondaries. But clearly there's an increasing demand for secondaries. Do you think that 401k plans getting into private equity could create an imbalance in supply and demand that might change the return profiles that LPs might be demanding from private equity?
Yeah, well, I think you're going to what Doug alluded to with, or specifically pointed out as to the guidance, the factors that sponsors have to look at in making this decision will preclude there being a rush in assets that would cause an impact on returns, because the department has clearly told fiduciaries, you can do this, but you have to do it intelligently. You have to do it prudently. You have to do it carefully. And you need to look at that the people who are making the decision, who they're choosing to manage the assets, to be the funds that are putting this together, are stable, are experienced. They have a good track record. They don't use the word track record, but that's really where it's pointing to. And so, fiduciaries will be going into this space, but doing it carefully, cautiously, in a way that they would have done if they were managing these assets themselves in their defined benefit programs. And so I don't think you're going to see a flood. And I think that's a good development from the point of view of the department, because had there been a flood of money, had there been bad returns, people would have been pulling back, not making these investments, and not being able to benefit the participants by getting in solid, appropriate investment opportunities.
And maybe if I could just,
go ahead, Doug.
Sorry, if I could just add a point to that, I think it's important to view the defined contribution opportunity for private equity within the broader context of what's happening from a secular perspective in terms of private DB money and public DB money shrinking. And so we would certainly agree that this is a very long-term opportunity, even with the guidance that was released, not just 2 months ago. We would not expect a flood, even to happen within the next, 24 to 36 months. We do think that this allows, the more forward-thinking plan sponsors to, really allocate resources and engage to really make an effort to add private equity to their plans. But that will still take, some significant time. And during that time, you'll continue to see the trend, which is the shrinking defined benefit market. And so, within private equity, we get this question quite a bit, almost in every conversation that we have with investors. Is there too much money chasing too few deals within the private markets? And, our answer has stayed consistent for a long period of time, which is there have been peaks and troughs in fundraising, over the last 2 to 3 decades, yet the returns have held up largely very consistently, and certainly consistently outperforming other public market strategies. And so it is important to view the opportunity in the context of what else is going on, both within the fundraising environment, but also within the investment environment too. And the one thing that we haven't mentioned, none of us have mentioned so far, is just the idea of the shrinking public markets. And this is something that's been, the regulators have been highly focused on, especially the SEC, in terms of just there being about half as many public companies today as there were 20 years ago. And so, our industry has rightly been very focused on providing excess returns over other asset classes for a long period of time. But there is this other very important tailwind to our industry, which is, it's very difficult to get access to the full exposure of the US or the global economy through strictly the public markets. And so there's an asset allocation tailwind to this effort as well.
Yeah. No, Larry, how will private equity managers address the responsibilities of being a fiduciary as per 401k regulations? Will it in any way affect the way managers invest?
Well, I think it goes to the question of how it's structured, but from the manager's point of view, to the extent you've got plan money coming in, whether it's DB or DC money, it's all ERISA money coming in, and those funds are going to be structured to decide whether to run as plan asset funds, run as VCOC funds, run as funds that are exempt from plan asset status by being under the 25% test. And so it is very likely at the level of the private equity sponsor that there's not going to be much of a material change. There are a number of funds that run as plan assets. There are quite a few more funds that do not. They either, again, fit one of the exemptions to be plan assets. It's going to be the manager who's running the target date fund, the CIT, who's going to be making those decisions and making that investments. They're going to be the fiduciaries, choosing the funds with good histories, stable investments, good returns, and they will have to evaluate whether or not those are plan asset funds and whether those managers will be fiduciaries. But my supposition is at the actual level of the investment, there won't be much change, because as Doug has said, we're having a pullback. The number of private funds that are invested in private equity is shrinking simply because the number of plans are shrinking. And as if we get back to a point where interest rates start to rise again, the number of frozen plans that will convert into annuities will increase, and the amount of capital coming from the DB plans will be going down. So I think the fund managers will be continuing to manage the way they've always done, to decide whether or not to operate subject to ERISA or not. And it will be up to the manager of the target date fund, the CIT, to invest those as a prudent fiduciary, which is consistent with their duties and responsibilities generally.
PE as a phrase captures a lot of different players, everything from venture capital, growth equity, buyout, lower middle market, mega. Who are the individuals within that are going to be the best suited for this change going forward? And Doug, you had mentioned that it's going to be the multi-managers that are doing that, but those often tend to be larger firms, don't they?
Yes, and I think that there are, sort of, you can think about us within the context of maybe, 7 or 8 or 10 global multi-manager asset management firms within the private markets. And we do think that this is a highly attractive opportunity for us and our competitors, just given the position that we're in the market, and the ability to, as Larry mentioned, not only use the primary market, but also the secondary and potentially the co-investment market to populate, what will end up being a smaller allocation within a target date fund complex. Now, outside of multi-managers, there are some very large firms out there with very diverse investment strategies, some of the big publicly traded firms, and certainly there's an opportunity for those firms there. And frankly, from the Pantheon perspective, we welcome that, because I think one of the very important parts of the puzzle that's missing right now is competition, and competition within, for a plan sponsor to be able to look across, not just 2 offerings in the space, but 10 offerings in the space. We think that that's a very good thing. And then just from a commercial perspective, the vast amount of money within the opportunity set, it simply just cannot be handled by 1 or 2 or 3 or even 10 firms over the long haul.
And there are many more $300 million managers than $10 billion managers, but obviously from a capital perspective, the largest players represent most of the capital. What opportunity will lower middle market or middle market firms have in this, or is it not really going to affect them? And Jason, maybe you might have a view on that.
Look, so I agree with everything that Doug and Larry have said on the topic. I think also, kind of pulling off of the theme of over time, you're going to have defined benefit plans in terms of size, declining. And I think as more firms, I think it will be the larger firms that probably get involved to the greatest extent first. But that doesn't mean that down the road there aren't going to be many in the middle market who look at this as a viable option, perhaps after some of the larger firms have sort of blazed the trail, so to speak. But I think that there are firms of every shape and size that are, of course, looking at, over the long term, what is their base of available, investors look like, and how is that going to change over time? And this is a big part of that. So I think that, I think what Doug and Larry have said is exactly correct. But I do think in time, this will be a factor for many in the middle market. I also think it is true, probably over the short to mediate term, that there will be some private equity GPs who say, this is a great development, and I understand that this is a longer term trend, but as John Maynard Keynes said, we're all dead in the long run. And right now I have a very good predictable set of defined benefit LPs. They like me, I like them, and so it's less of a priority for me. So I'm sure you'll see, obviously, some of that shake out, kind of everywhere up and down the market. But I think in the middle market space in particular, there will be some who will, want to kind of stay focused where they are with their investor base, and they may not have as much of an interest. But I think by and large, over time, you're going to see a tremendous amount of interest here, not only from the largest members and the largest participants in the field, as Doug has said and Larry has said, but also I think from folks in the middle market as well.
And Jason, what have the policymakers' responses been to the DOL actions?
Yeah, well, look, I think overall, so far, the vast majority of government officials, academic experts, and economists who've taken a look at this have really praised DOL's actions, because I think they view it as, over time, it's giving more, hardworking Americans, Main Street Americans, opportunity to get access to this best performing asset class for pension plans that until now they haven't had as much access to for a variety of reasons. So, I think so far we've heard good things out of, SEC Chair Clayton. Obviously, the chair of the DOL, Eugene Scalia, has said good things. We've also heard a number of folks from academia say, yes, this is a good trend. This is something that's important. We've heard a lot of the think tanks echo that. So I think thus far, when we've seen sort of politicians of all political stripes so far, many of whom say, look, on net, this is really a good opportunity. Some may have, more or less concern or more questions, But I think overall, it's off to a strong start. With that said, there will always be, some folks, sometimes it's interest-driven groups or opposition groups who don't like the idea of exposing more retail investors to greater performing asset classes. And so, there will still be skeptics. And my hope is that in time, the data and the facts on the ground will overwhelm the skeptics, and people will see that this is really a tremendous benefit to retirees over the long run if done appropriately. And I have confidence that that is the way it will be done.
Maybe for Larry and Jason, what if any consequences will the upcoming elections have on this particular issue?
I'm happy to dive in, and Larry and Doug, feel free to add in. I mean, look, elections have consequences for sure. Will this coming election have an impact on what happens on this issue at DOL? Possibly. Again, I think that the reality of it is if you have a change in administration, there will be a new administration coming in with a whole series of priorities across the gamut. Even if you have a second Trump term, if you have a second Trump administration, they will have a whole new set of personnel and priorities to execute over the next 4 years. Our hope is that politicians on both sides can look at this and say, this is something that is a net positive. It's a net positive for investors. Some politicians may disagree over the exact scope. Some may want additional attention or focus on any number of particular sort of ancillary issues. But our hope is that over time, policymakers of all political stripes will look at this and say, look, this is really a good thing. It's not a requirement. It's not that DC plan investors have to invest in private equity. But if an ERISA fiduciary wants to include, after going through a whole series of steps, wants to prudently include private equity as one of its diversified investment options in a target date fund, that's a great thing. That's a good thing and should be encouraged. And certainly, it's been our effort over the last months since the release and going forward to educate policymakers on that in Washington, to make sure that they're aware of what the good potential here is, and that they're aware that this was done in a very responsible way, in a way that protects investors, but also gives them exposure to a tremendous asset class that thus far they've not had as much exposure to. And at the end of the day, Main Street investors are going to be the largest beneficiary of this trend, and that's a good thing.
And I think one of the great things about the DOL guidance that did come out is, while we all think of it as being potentially groundbreaking, the DOL broke no ground. Their guidance simply says that the principles of ERISA permit private equity to be incorporated into a 401k investment. And that's right. There's nothing in the statute itself, nothing in the real guidance that would have ever precluded that from happening, but people were afraid because of the activity in litigation. But more importantly, what they said was they set forth a framework that's very consistent with traditional ERISA guidance for fiduciaries to evaluate, to take responsibility for introducing this asset class into a 401k plan in a prudent and intelligent manner. And it would be very hard for someone to come back and say that this guidance was not consistent with the statutory authority that existed before it was given. So it would be hard pressed for a different administration with a different view to come in and say that this guidance was in any way wrong or in any way went past what the department's authority permitted them to do.
I'll take this moment just to ask the audience to feel free to submit questions. I know we've gotten a few, and I will give some time for those audience questions shortly here. The idea of retail investors accessing private equity is not a new topic, and there have been other areas where this has already happened successfully through software platforms and the like. Now, Doug, do you have any thoughts on what's already happened and whether those avenues are likely to change or evolve for retail investors accessing private equity more broadly?
I do think the important trends and the trends that we've been seeing is sort of how to democratize this asset class and provide it to individual investors in the same way that we have been providing the institutional marketplace these investments, and then that sort of manifested itself into more product structuring, more registered funds, closed-end evergreen funds that can be distributed to not just qualified purchaser, 5 million and up investor, but accredited investors. And I know that there's a large effort going on to maybe even expand that beyond accredited investors and into sort of what I would consider to be, sort of true retail investors. I think this guidance only provides, even a stronger tailwind to those efforts. I think, from a product structuring perspective, evergreen funds are going to be a big part of the DC opportunity, and whether they're structured in a collective investment trust or 40 Act wrapper, I think you'll see both of those things. And so it is sort of, while in my mind and in Pantheon's mind, defined contribution and private wealth are two distinct opportunities. Clearly, they're interrelated, because from a private wealth perspective, we're talking about sort of my after-tax accounts. From a 401k perspective, we're talking about my pre-tax accounts. In the end, we're still talking about managing my personal money and trying to put that into private equity investments. But the way that you go about getting private equity into an after-tax brokerage account and into a pre-tax 401k account is just vastly different. And so while they're interrelated, and certain aspects of them, especially on the product development side, for more of what I would say the pure democratization is, taking what was a $10 million minimum investment fund and delivering the same investment strategy in a $25,000 minimum investment, I think that part of the retailization of private equity is very relevant and will continue to be very relevant for the DC space. And alongside that is the education requirements. The good news is the industry has been, very forward thinking in terms of how do we educate these investors and their advisors in terms of what is this asset class, so they're not just learning about it through the mainstream media, which is, can be somewhat biased. How do we really educate and really talk about what the value proposition of the industry really is, and marry that up with product development over time. So I do think, while there are certain aspects of it that are very relevant, that can only help over time.
Yeah, we've seen a lot more of our clients having longer J curves, asking for extensions on their fund, and then you see folks issuing longer dated funds to begin with, and more of these evergreen funds. One of the interesting dynamics that'll be worth paying attention to is, do we actually start seeing more funds just going out right now and setting themselves as evergreen funds, or possibly investment holding companies? One of the benefits often touted by private equity investors into management teams is, the ease of thinking longer term, as opposed to quarterly earnings in a public market company situation, which is why we've seen a lot of companies stay private a lot longer than historically they have been. Do you think there's any chance that we start seeing private equity firms being structured as investment holding companies and being listed as a way to access retail markets?
So my personal opinion on that is likely yes, especially with what seems to be the proliferation of SPACs, especially in the last even sort of 2 months. We haven't yet seen a multi-manager private equity approach to a blind pool IPO, but I don't think that that's out of the realm of possibilities in the short term. The tricky part about that is, when you deliver an investment solution through a structure like that, you're subjecting private equity to the public markets. And so there is an element of getting in and out of net asset value rather than the public market trading price. And I know our industry has talked quite a bit about, over the last 3 months, how there seems to be sort of a dislocation between maybe what we're seeing in the private equity industry and the public markets, and specifically the stock prices. And so my personal view on that is, I'm not sold on the long-term opportunity of wrapping private equity into a listed structure, just because I really like the idea of the true investment performance coming through the NAVs, rather than somebody on the outside, the Wall Street analyst groups, evaluating what the portfolio may look like in the future and assigning a share price to that portfolio, rather than just simply holding on to the investment until it is exited and realizing the proceeds when it is exited.
Right. And maybe Jason, what's next? What are the near-term catalysts required for fruition and moving pieces that will lead to opportunity creation for both GPs and retail investors?
Yeah, well, I think just yesterday, Dalia Blas, who is director of the SEC's Division of Investment Management, gave a speech at PLI where she talked about, in part, efforts that the SEC is undertaking to facilitate, greater, quote unquote, retailization, or exposing more retail investors to private market options. And she did talk about, things like funds of private funds that, frankly, although there's no law that prohibits them being marketed to retail investors, there has been staff guidance for some time that it should be limited to at least accredited investors or qualified purchasers. I think you may see the SEC continue to, on a going forward basis, to look at some of the other things they can do to facilitate greater investment here, and sort of working in tandem with the good clarification that the DOL put out. I mean, obviously, you mentioned in one of your earlier questions, elections do have consequences, and we're coming to the end of Chairman Clayton's term at the SEC. A big priority for him was unpacking, retailization and unpacking this trend of, more and more companies staying private longer, not going to public markets, and how do you responsibly enable more retail investors to get access to that. So I do think at the SEC, they have a number of items that they are considering. They put out a whole concept release last year on this topic. We at the AIC filed a comment letter on that, and have had numerous conversations with the SEC on the importance around these issues. There's another pending rule that's out that would modify the accredited investor definition to some degree. So again, I think there are a lot of moving pieces from a policy perspective, and of course, that is one of the areas where we will have to see if the elections will, they may change priorities, right? Depending on who comes in and who is the new chairman of the SEC, regardless of who wins at the top of the ticket, there will be different priorities, and different things will move up or down the priorities list. But I think in the short term, it's good to see that the SEC remains very focused on this. I think this is a trend and a set of policy issues that will transcend the current chairman and the current administration. Any SEC chair is going to have an interest in finding out ways to unpack this puzzle and provide greater access in a responsible way for retail investors. So I think you'll see some additional action there, and we'll see what happens going forward as things roll in. Will there be additional legislative efforts to promote this further, or some legislative efforts to restrict it further? We'll have to see. But I think in the meanwhile, the important thing for our industry is telling the story about all the positive things we do, why what the DOL did was a very positive development, why it's good, not only for the industry, but why first and foremost it's good for Main Street Americans to enable them to have healthier, more bountiful retirements. And so more to come, and it's an exciting time to be looking at all these issues.
Abi, just one thing to add to that. I think, in the 401k space, the driving force of actually implementing private equity as an opportunity for the participants is got to come from the plan sponsors. The plan sponsors have to undertake the work, and there's some work to doing this, to get the opportunities into the plans for their participants. They have to get over the concern that there's a different path that doesn't have perhaps as much work associated with it, as much risk from a reaction point of view, either from participants or litigants. But if the plan sponsors undertake to provide a better opportunity for return for their participants, and I think we're going to see the bigger companies where they have personnel who are familiar with these kinds of investments will be the original driving force into these products. And if we see that happen, and we see success with them introducing those products, more and more sponsors will do it, because I don't think you'll see the fund managers, the people who are currently managing a lot of assets in a 401k plan will do this ab initio. but if the plan sponsors ask for it to be done, they will be responsive to that as time moves on.
Yeah. Jason, you mentioned private fund of funds or fund of private funds, as being a solution for access as well. And maybe that's one way some of these lower middle market firms get more immediate access to this. But how does that relate to the conversation about fees and fiduciary when you layer in a fund of funds in between private equity fund and the plan?
Yeah, I mean, look, I think it's important whenever you talk about fees as well is to look at what's the net of fee outcome, right, for those who invest. And at the end of the day, one of the points that we always, opponents of the private equity industry will say, oh my gosh, look at the fees, and they'll wring their hands about the fees, ignoring conveniently the fact that private equity for quite some time has been the best performing asset class, net of fees. Oh, and by the way, net of carried interest as well. Carry's not a fee, but it's a profits interest that firms derive from successful investments after certain hurdles are met. But net of fees, we're the best performing asset class out there. So I think people need to sort of wrap their arms around that concept. And I think, again, as is currently the case, I mean, disclosure is key, and the private equity regime, has disclosure for investors. They have disclosure for LPs. They have disclosure for regulators. And so, I think, again, appropriate disclosure and contextualizing of everything should enable, prudent ERISA fiduciaries to kind of make those determinations and over time, DC plan investors as well.
So, I've got a question from the audience. Are GPs able to make investments in a target date fund, which includes their own VC fund, or is this still considered a prohibited transaction? Maybe Larry.
Yeah, well, it depends on the structure, but it ought to be able to be done, because, again, when we look through the various structures, whether there's a prohibited transaction, there are two different types of prohibited transactions. There are what are referred to as the per se, which depends on whether you're party in interest, and properly structured that can be readily addressed. And then there's the question of whether the fiduciaries themselves are engaging in transaction for the benefit of affiliates. But if you structure it in a way that evaluates those issues, doesn't create a benefit to the fiduciaries making the decisions, once that opportunity is made available, then participants within the fund ought to be able to, do their own investments through their own 401k plans. There may need to be, to the extent that the sponsors are directing their own plans into there may need to be some fee rebates and offsets in order to avoid the potential that the fiduciaries are individually benefiting from the decisions. But that's a tried and true methodology under ERISA that people have used for a very long time.
Right. Another question, this one's specific for you, Larry, as well, is can you expand on your comment that target date funds allow for fiduciary responsibilities to be borne by the TDF manager rather than the plan sponsor? The EBSA outlined 6 steps for sponsors to conduct an annual review of TDFs, which includes the underlying funds and fees.
Mm-hmm. Sure. So again, it depends on where the structure is and who's making the fiduciary decisions. But one would anticipate that the sponsors are going to pick a manager, whether either a CIT, which is going to be plan assets and therefore be a fiduciary, or if it develops into mutual funds. But let's take the CIT. So the manager of the CIT is going to have fiduciary responsibility. It's going to be a 338 manager, and is going then to make the decisions within the fund themselves. So the plan sponsor fiduciary is going to have to evaluate whether or not the manager who's going to be choosing that is capable of making that decision. But in large respects, the decision is going to be exactly like choosing a manager for your DB plan. Making a prudent decision to delegate investment responsibility to someone who is a qualified manager and can manage the assets appropriately. There will be oversight. There will be monitoring requirements, just like it would be in the context of a DB plan, to make sure that that fiduciary is fulfilling its functions appropriately. But the ultimate decision as to which funds to go into, how to invest the assets that are within the target date fund in particular investments. That will be the responsibility of the manager of the CIT. And again, just like in the DB context, when the named fiduciaries of a defined benefit plan choose a manager, that manager then goes and makes investment decisions, and the named fiduciaries do not have direct responsibility for any of the decisions made by that manager. There's an ongoing duty to make sure that manager is fulfilling its responsibilities prudently and appropriately, but that would be the end of the responsibility of the sponsor.
Next question, how are capital calls for PE handled with 401k participants? Also, can this be used for structured credit funds or direct lending? Maybe Doug?
Sure. So I think, you know, there will be several ways to handle capital calls and distributions within sort of a target date fund structure. The way that we have developed it is to sort of handle that within the structure that we have, which would form the private equity sleeve within the target date fund structure. So that is to say, we would not expect a 401k plan participant to be subject to any capital calls. And so any unfunded liability would be an unfunded liability within the target date fund construct or within our product, which is the sleeve of the target date fund construct. And I think that's an important point. I would expect the first adopters of private equity to be, you know, highly sophisticated plans that have a long history of dealing with investing in private equity out of their DB plans that they will likely want to manage liquidity themselves within the target date fund construct. But we would certainly think, and we have developed a solution to manage liquidity, capital calls, and distributions within the actual structure that we have developed, and we think that both will end up being used within 401k plans. And then to the latter half of the question, while the guidance is specific to private equity in terms of it says the words private equity, I think, you know, Larry largely hit the nail on the head earlier in that, you know, this didn't break any new ground. And so from that perspective, there's no reason why you couldn't translate this guidance to other private investment strategies. But admittedly, the guidance isn't as clear cut as I think maybe, you know, certainly the GP landscape would potentially like it to be, or potentially even the plan sponsors would like it to be. And so I certainly wouldn't be surprised if there are other asset management firms more focused on private credit or potentially private real estate or private infrastructure that look for similar guidance, even though, you know, from our perspective, and I'd certainly be very interested in Larry and Jason's views, you can sort of translate, for lack of a better term, this guidance into other private equity, other private investment strategies.
Yeah, we agree with that completely. We, you know, again, what the DOL did here was provide guidance as to how to apply the statutory provisions to a particular asset class, but we think there is no reason why the same logic, the same analysis could not apply to different asset classes with the same kinds of you know, liquidity issues applicable to them.
We agree at the AIC as well.
Maybe last question, I'll ask each of you can have an answer. Who's the happiest constituency from this guidance? Is it retail investors? Is it 401k plan managers? Or is it GPs? Doug, you want to go first?
Plan participants.
Right, I think at the end of the day, that's exactly the right answer. It's because, you know, the studies do show that the defined benefit plan returns have been consistently better. And that's in large part because private equity investments have been one of the strongest asset classes for DB plans for a very long time. And that's just been denied to 401k participants. And that makes no sense in you know, investments that are investments for a very long time. Even for someone who's, you know, in their 50s or 60s, we're talking about that being their retirement assets that needs to fund, you know, their many years of retirement past 60, 65, 70. And so the opportunity for them is the ultimate victory here.
Yeah, I wholeheartedly agree. I think at the end of the day, it's going to be the plan participants who are the biggest beneficiaries, and that's a good thing.
Yeah,
Wonderful.
I agree.
Well, great. Well, I want to say thank you to our audience for participating and to all of our panelists as well for taking the time to speak with us today. Please feel free to reach us at trustvista.com if you have any questions or you'd like to connect with any of our panelists. And also, please feel free to look at our history of webinars, and please subscribe to our podcast, Trust Vista Talk podcast, as well, wherever you listen to podcasts. Thank you, gentlemen.
Thank you.
Abby.
Take care, everyone.
Bye-bye.